Hi, folks. Thanks for clicking on the link. Today we're going to talk about reverse mortgage myths and what nobody told you. So I look at a lot of videos about reverse mortgage, and I started looking through the comments, and there's a lot of comments of what people perceive as how these work. And most of the time, it's just lacking explanation, and that's why we get those negative comments. So I want to address those first and foremost, okay? So what nobody told you, the top misunderstandings that trip homeowners up, and the facts that you need to know to make an informed decision. First of all, I want to address who this video is for. Number one, it's the homeowners, 62 and above. You've built equity in your home and you want to understand whether the reverse mortgage can help fund your retirement without monthly payments or giving up ownership. The second audience is the heirs and family. You want to know what reverse mortgage means for your inheritance, your rights, and how to protect your family's interests when the time comes. I think it's very important to when you do, or a loan officer does a consultation for reverse mortgage, to include the heirs so that they know all of the things and that it entails, and also so that they can ask questions before consummating the loan. Okay, so number one myth, the bank owns my house. Okay, so this is a reality. This is the number one misconception that is out there. You retain full ownership of your home. The lender places a lien against it, just like a traditional mortgage, and the loan must be repaid when you sell, move, and move out permanently or pass away. Your heirs can still keep the home by paying off the loan balance. Okay? Now, the next myth is I can lose my home if I live too long. Reality, the loan never becomes due based on age or time. You can live in the home as long as it remains your primary residence. Maintain the property and you pay the taxes, and there's no maturity date. Okay? The key here is making it your primary residence. So how do we define that? Well, we define that was if you move out for a longer period than 6 months at once, then it's no longer your primary residence and the loan becomes due. Okay, this can mean went to a care facility and that's where I'm going to live out my days because of whatever the circumstance is, or maybe I went to a care facility to get repaired and it took 8 months and then I'm able to come back. So if you go longer than 6 months, then it becomes not a primary residence. Okay. Number three, nothing is left for my kids. So the reality for this is that it depends entirely on the home value versus the balance. If the home equity appreciates or you don't draw the full amount, there may be a significant equity remaining for the heirs. Some families strategically limit the draws to preserve the inheritance. Heirs also have the right to buy at 95% of the appraised value or the loan balance, whichever one is lower. Okay, so with this, we have to consider that let's say that there's a homeowner that's got a pile of money over here, which is we call their pension, what they saved up over time, and then they have their home, which has a bunch of equity in it. Okay, the equity can't be used, and if you still have a payment, you're drawing from here, from the pension and Social Security, you're taking money from there to pay down the mortgage, increasing your equity. Equity, remember, equity is money that's trapped in your home that you need a transaction to access. So we're either going to diminish the old money, the pension money, or we're going to diminish the equity. And it's better to diminish the equity since it's difficult to access anyways, especially when we get to those days where we have a limited income, than depreciating the liquid cash that is way more fluid and accessible. Okay, so it's basically picking one over the other. But if you have that pension and you have the equity, think about how am I going to pull that equity out, or how am I going to use that equity to live? You have to get a loan of some sort. And if you're going to get that loan and it's a forward paying mortgage, like a regular mortgage, you're going to use this other pile of money to pay that mortgage, still diminishing this. That's why the reverse works as a good solution. Next myth, number four, my Social Security and Medicare will be affected. So the reverse mortgage proceeds don't count as income. So Social Security and Medicare are unaffected. Okay, now We do have to consider Medicaid or supplemental Social Security. They are affected since those are needs-based programs. The distinction trips up a lot of people, okay? So in a reverse mortgage, you can take a lump sum of cash if you have the equity, and then you put it in your bank account. And that lump sum may disqualify you from your Medicaid because you don't seem to appear to have a need. So what do we do for that? Is we, instead of getting a lump sum cash, we get a line of credit. And we can spend that line of credit however we want. You could take trips, you could do repairs, you could do whatever, maybe, give it out to the grandkids or something. But it is a line of credit. It's not cash sitting in your bank account. So that way it doesn't affect your needs-based programs. Number 5, the myth is I have to use all the money at once. Well, we just talked about that, right? The reality is most reverse mortgages come with either a line of credit, they can give you monthly payments to make your other bills, or a lump sum, or a combination of those. The line of credit option is especially popular because you only draw what you need, and the unused portion actually grows over time. So myth number 6 is that it's a last resort for desperate people. Now, although there might be people out there that maybe weren't able to save that pension, that stack of money, and the only thing they have is the equity in their home. They have no other way to do retirement and lower their expenses other than a reverse mortgage. However, increasingly, the financial planners use reverse mortgages proactively as a retirement income. Drawing from the home equity first can preserve investment portfolios during market downturns, and it's being repositioned as a financial planning tool, not a distress signal. Myth number 7, lucky number 7, the fees make it not worth it. Okay, so there are upfront costs, origination, mortgage insurance, and closing costs. Those are real and they can be steep, but HUD has capped several fees and the math changes depending on how long you plan to stay and how much equity you have and what alternatives you're comparing it to. So for someone staying 10 plus years, it often pencils out. But for someone who's planning on moving in 2 years, it usually doesn't. Myth number 8 is I can use it to buy a vacation home or an investment property. So the reality on this is you can only use it for a primary residence. Okay? Only the primary residence qualifies, period. No second homes, no rentals, no vacation properties. However, there is one little side note or footnote to this. You can purchase with a reverse mortgage a duplex, triplex, or fourplex as long as you use one of the units as your primary residence. So you move into one of those units, and let's say it's a triplex, and you can collect rent from the other 2 units so that you can generate an income. Okay, that is possible. Remember, keeping it as your primary residence. Myth number 9, my spouse will lose the home if I die. Well, this was a real problem historically, but HUD fixed it with rules around the non-borrowing spouses. Non-borrowing spouse is defined as a spouse that isn't of the right age to qualify for the reverse mortgage. So we've got a 67-year-old person who qualifies, and the spouse is 59 who doesn't. So we would put them in as a non-borrowing spouse. Okay, if structured correctly, both spouses on the loan, or proper protections in place at origination, the surviving spouse can remain in the home even if they aren't the borrower. Getting this right at the beginning is critical. Okay? And the last myth, number 10, the balance can exceed what my house is worth. Well, reverse mortgages are non-recourse loans, and a non-recourse loan means that they can't come after me for any of my other assets other than what I put up as collateral. So that's all they can take. Okay? Neither you nor your heirs will ever owe more than the home is worth at the time of repayment. So if the loan balance exceeds the home value, the mortgage insurance covers the difference. That debt does not pass to your heirs or personal assets. So that's the top 10 myths. I hope this was helpful. If you'd like to schedule a personal meeting to go over what you qualify for, click on the links so that you can schedule a personal consultation. Thanks.